Okay, folks, welcome. We are live here with Quantum Leap live on January 12th, and I'm excited to welcome a new guest and also a new format. But before I get to that, I just want to check in with my esteemed co host, Cory. How are you today, Cory?
I'm doing good. Back from the break. How are you?
Good, good. Glad to get started. And I was looking forward to having Jake on with a very timely discussion of taxes. Jake Birnberg, he's known as the Deduction Detective. So he's a very unique person in tax and tax management or doing your taxes really to save you on your tax burden, as you'll see, is not kind of your garden variety accountant. I did want to announce that we are doing a special format today on Quantum Leap that we're going to be doing where the presenter presents for 10 or 15 minutes and then we do the interview after that. So we're really looking forward to Jake's presentation, and I'll let him tell us more about what he's going to present on, but it's really very timely tax issues for small businesses and entrepreneurs that you want to know about. And I did want to just read a brief introduction to Jake so you know a bit about him before we dive into some of the details. He graduated with a degree in finance from the UC Berkeley Haas School of Business and has a background in investment banking and financial planning, where the key is looking forward to meet clients' needs for a lifetime and sometimes beyond. He has worked for firms such as Dean Witter, Shearson, Lehman, and Wells Fargo. He is an IRS enrolled agent licensed in 50 states to appear before the IRS and state agencies to represent his clients. His forthcoming book, entitled The Capital Gains Playbook, shows investors how to reduce or completely avoid capital gains taxes upon the sale of property. Very, very timely right now. He specializes in helping business owners and real estate investors through proactive strategic tax planning, where he finds the uncommon deductions, missed opportunities, and mistakes that cost him thousands in wasted tax dollars every year. He also helps people invest their funds wisely. Jake's firm was voted Oakland Magazine's best tax practice in the East Bay, and with that, he is really top of his field and very strategic in his thinking about how to save you on your taxes. So this is really a must-see presentation for any small business owner and entrepreneur. And with that, I'll turn it over to Jake. Welcome, and we're looking forward to your presentation and a discussion afterward.
Thank you. Thanks, David. Thanks for inviting me. I'm really glad to be here and look forward to just sharing some stuff here. So I know what you guys are probably thinking in terms of listening to me talk about taxes. I know what that could be like. So I will try to make this interesting and try to make this important work that's something that you will enjoy. So, and move pretty fast. So I've got a lot to cover anyway. So here's the financial roadmap for business owners, basically. You start and run a successful business. Now that's just one bullet, and yet that could be an entire presentation. It's like, how do you start a business? What do you do? What kinds of things need to be in place, and how do you succeed? You know, that's an enormous amount of work that can go into that. And then once you do succeed, well, guess what? You have to pay taxes on your business income. And then you save for retirement. And part of one of the ways of reducing your taxes is by putting money away for retirement. But then you have to save for retirement. Then when you're ready to retire, you sell your business. Now, there's a question as to whether or not you'll be able to sell your business. Some businesses are really just your job, and there's not going to be any value, but there might be ways to deal with that. And then you have to pay taxes on the sale of the business. And then you invest your remaining funds, and then you pay taxes on the income generated by those investments. And then you withdraw money from your retirement savings accounts, and you pay taxes on those withdrawals. And then you start your Social Security, and then you pay taxes on up to 85% of your Social Security income. So basically, paying taxes is an integral part of your financial life. both now while you're in a business and going into retirement. So retirement planning is about reducing your taxes both now and in the future, because that makes your retirement resources last longer. It requires you to risk to low. You don't have to have as much risk for your capital to grow, and you get better quality of life in retirement because there's a lot less to worry about. There's a lot less taxes. And then we use a balanced approach to invest. Investing leads to more security of principal, higher yields, and money lasting longer in retirement. So this is it's sort of an all-encompassing plan. So how do we achieve lower taxes? Well, we try to minimize taxation of business and asset income, so you have more to put in retirement. We minimize the taxation of business and asset sales. So when you sell a property, when you sell a business, we cut the taxes there. Minimize the taxation on the distributions from your retirement accounts. That is very possible to do that. It's also possible to minimize taxation of your Social Security and maintain security, the security of principal, and maximize earnings on your retirement accounts. So the biggest mistake that people make, especially business owners, is they don't plan for the taxes that they have to pay. And this is the Chief Justice of the Supreme Court at one point had said there is nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. So it's completely legal to plan to avoid taxes. Now, that is important, and it's important to do that. And the difference between tax planning and tax evasion is basically 3 to 5 years. So, because one is legal and one is not. So when we do tax planning, there's a difference between tax preparation and tax planning. Tax preparation, which almost everybody has to do on an annual basis, it's reactive. You're just recording history and writing down what happened, what kind of income you had. It's done for compliance reasons, to stay within the law. You have no control of how things are going to turn out. You use tax software to do it, or you go to an accountant who's going to use tax software to do it and often not think too much about the results. You end up paying for a lot of things with after-tax dollars. And taxes can be a lot low, and then you get a lower cost. It's lower cost than actually doing tax planning, and it's also an annual service that you need. Whereas tax planning is proactive, you're looking into the future and writing out like what you're going to do to reduce and eliminate certain types of taxes. It's the key to financial defense. There's basically offense and defense. Offense is going out and making more money. Defense is saving the money that you've made. We all know you can go to Geico and save 15% on your auto insurance, but what percentage of your total expenses is auto insurance? It's usually very small, whereas taxes can be the biggest or second biggest expense that you have. So it really does make sense to try to focus your financial defense on taxes and try to reduce the costs there. It's a manual process. It's putting together a puzzle, pieces of a puzzle, because we have to do a cost-benefit analysis on every possible strategy. We have to look at everything that can be done and decide what should be done. You end up using pre-tax dollars to pay for things much more than you use after-tax dollars. Now, pre-tax dollars can be twice as big as an after-tax dollar. Let's just take somebody in even the 24% tax bracket, which is pretty low. If you're paying 24% in taxes and you're self-employed, then you pay 9.3% in state taxes, that's 33.3, and then you have to pay self-employment taxes, that's 15.3, so that adds up to 48.6%. I'm sorry, 49.6%. So it's basically half of your dollars can go to taxes. So it really makes a lot of sense to try to avoid that. You get this is a much higher value service, and it lasts 3 years, and I guarantee the results of my tax planning. There's two kinds of dollars. There's the pre-tax dollars and the after-tax dollars. I'm not going to bore you with all this stuff. We don't have time. But basically, you have these two types of dollars. Pre-tax dollars are much bigger, about twice the size of after-tax dollars, and it really makes sense to try to use pre-tax dollars just on anything that you can. And that means finding a way to expense it. So today's takeaway, if you get one thing from this session, this should be what it is. You lose every time you spend after-tax dollars that you could for something that you could have paid for with pre-tax dollars. And that's really super important. So that's the goal when you're in business, is to use pre-tax dollars for everything that you can. There's a little joke here, which I love these jokes. I don't know if you can read this. I will read it for you. The IRS agent says, "How can you explain these outrageous deductions?" And he says, "Well, you see, I'm a newspaper columnist and I comment on life, and life is deductible." Well, the fact of the matter is there are many things in life that you're paying for, and they are deductible if you do things right. So if you have a business, you can pay for part of it. You can deduct part of your home, you can deduct your phone, you can deduct part of your car. There's all kinds of things you can deduct that if you just had a regular job, you couldn't deduct at all. So minimizing taxes in business has a lot to do with, there's a lot of different things we can do. Making the mistake of not being proactive and mistaking proactive for aggressive. I mean, we do a lot of things that are considered aggressive, but because we're proactive, because we set things up in advance, because we know how to leave the right kind of paper trail and do it correctly, even if we do get challenged, we can stand up to that challenge. And the fact of the matter is there's a lot of different things we can do to reduce the probability that you're even going to get audited. Having the right business entity. Different business entities get audited at different percentages, and by having the right business entity, we reduce the risk of being audited. We don't have to be afraid of the IRS, and it also opens the door to many deductions that are not available as just a regular sole proprietor. Having the right retirement plan can make a huge difference in how much you're allowed to set aside for retirement. And if you're in a high income tax bracket, setting money aside for retirement is very important because it reduces your taxes now. You end up taking a deduction for it, and then later on, you'll pay taxes, but at a much lower rate because probably you won't be in such a high tax bracket, and there's a lot of things we can do to avoid the taxation inside that retirement plan. Having family employment shifts the burden of the tax from yourself to relatives, and by doing so, you end up in lower tax brackets. Sometimes you don't have to pay any employment taxes. Missing medical benefits. Medical benefits generally go on Schedule A, and there's a 10% reduction. 10% of AGI reduction of your medical benefits. So I have clients who spend $30,000 a year on medical benefits and don't get to deduct a dime of it. And if you play your cards right using things like a MERP or an HSA, you can reduce, you can have deductions for your medical expenses that will come through and that we consider business expenses. Missing a home office expense. That's a very important thing to do, and it is allowed. Maximizing your car and truck expenses, maximizing your meal expenses, your travel expenses. There are things we can do to increase the amount that you're allowed to deduct for both meals and travel. So that's what we do while you're in business. And then at some point, you come to the point where you're planning to transition and retire. And when you're planning on retiring, well, if you have depending on the type of business you have, excuse me, you can possibly sell that business. Now, a lot of people have businesses that are not really saleable because it's really a job that they've created for themselves, like real estate agents, attorneys, people like that. They are the business. But there are things that can be done to create a business that is saleable out of your business. So one example is we took somebody who was a real top hitter in the real estate industry, and we kind of helped them create a system for generating leads. They were able to sell that system for generating leads and get a sizable amount for that. And then we're also able to help people get more. If you do have a business that you can sell, we can help you get more for it. Just by tweaking your business model a little bit, because there's a lot of information inside of your books. You know, when people do their books, there's a lot, you get financial statements, and there's a lot of information in those financial statements. Most people don't know what that means, or how to use it for management, or how to use it to help you grow a business. That's one of the things that we do with our clients. And we're able to, if you're just able to do a few things differently, you can add maybe 10 or 20% growth on your business. And if you do that in 1 year, you'll get a higher multiple when you sell the business. And that can end up with being 40, 50% more than you were going to get for the business before you did any kind of planning around the transition. Then you have to pay capital gains tax, and capital gains tax rates can go as high as 20%. Plus there's an additional investment tax of 3.8%. And there are state taxes as high as 13.3%. So that in California, and that can bring your tax as high as 37.1%. The good news here is that with proper planning and using one of the strategies that are available in the sale of a business or an asset, a building, we're able to reduce or eliminate this tax. And that leaves you with a bigger pool of money to start with when you're paying taxes, when you're going into retirement. So we have over a dozen strategies. Not all of them work for everything, but there's over a dozen strategies, and the IRS doesn't really want you to know about these things. There are a lot of different ways of using different strategies. The most commonly known strategy is, I would say, the 1031 exchange, and that used to work for selling a business and no longer does. It does work for selling capital assets, homes, buildings, stuff like that, but it's not necessarily the best thing to do. And there's other things that you can do that can work out better in many cases. So there are so many different things to be done and so many different situations that you can be in that it's outside the scope of this presentation. So I'm just going to leave it at that. And if there's an issue that you have around capital gains, you're welcome to give me a call. So basically, when you have your retirement account, usually all of it is subject to taxation, but there are ways of reducing the amount that can be subject to taxation. And by doing things like prepaying and using different types of accounts like Roths and insurance types of accounts, we're able to reduce, you end up paying a little bit more up front, but then your taxes later on are much less, and the cumulative amount after about less than 10 years, this is somebody who's retiring in 2022, and by 2030, she will have paid all of the taxes that she needed to pay on this, and on her retirement plan. And it just makes a huge difference if you don't have to pay tax on all of the money inside your retirement plan. And the way that we do things, sometimes we can cut the amount of taxes that you have to pay in half, because you're only paying tax on half of your retirement account instead of the whole thing. And for many people, when they retire, about 90% of their assets can be in a retirement account. And then the amount of their Social Security that is subject to taxation is also something that we can address. And by just doing things as is, these pink line is the amount of Social Security for this client that they would have had to pay taxes on every year. But by doing things a little bit more creatively and planning in advance for it, for how we're going to deal with that issue, we're able to significantly reduce the amount of Social Security that's taxable on an annual basis. And this is the cumulative amount of Social Security that's taxable. We're starting over here. I mean, Social Security is not going to be, this client's like around 60, so it's not going to be, it's going to be over 10 years before they have to take any Social Security anyway. That's why that is so like that. And this is the cumulative taxes that you have, that they're going to have to pay. So basically, the retirement is in 2022. So we pay, actually this model was done a few years ago. So it's, you know, the first few years we pay more taxes and then we level off. But if you don't do anything, you just keep paying and paying and paying, and it ends up being a lot more. So one of the things that we offer is a no-cost tax return analysis. That really helps people know if they have any mistakes, and if they're, you know, on the one hand, are they making an actual mistake, and on the other, are they missing opportunities? We then create a plan. If you decide to work with us, we create a tax plan, we create tax implementation documents, and we do that on a continuous basis for our clients. So why tax planning? Well, before tax planning, this is your taxes, this is your lifestyle, your retirement, vacation, charity. But afterwards, your tax as a percentage of your total income gets reduced significantly, and you have a lot more money for your lifestyle, for retirement planning, for vacations, and for charity. So basically, there's more green left in it for you if you do tax planning than if you don't. So we're not just another accountants. We guarantee 200% ROI guarantee on all our tax planning engagements. That means that if you engage us to do a tax plan and you don't save at least twice as much as what we charge you in that first full year, you'll get a refund. So we do a free tax return review, and there's no free, no obligation tax consultation to see if you qualify, because not everybody really qualifies for this. If you're not paying enough in taxes, it doesn't make sense to do the tax planning. It ends up costing too much. So we do a cost benefit analysis on everything we do, make sure that you're saving more money than you'd be spending on the plan. That's the end of my presentation, and I'm going to stop the share.
Great work, Jake. And I did want to just get provide an initial reaction, get the same from Cory. I just thought that was a great, succinct presentation about the impacts. I wrote down, the taxes, income taxes on small business are as high as you said, about 49%, on marginal income, and capital gains on real estate is 37% with the California tax. So really, between a third and half your income can go to taxes, especially if you're not careful. And as much as we all love taxes, you don't want, all of your money going into taxes. And I think that's a, very timely quote from Chief Justice Rehnquist about there's nothing illegal about being smart about your taxes. That's what all the wealthy folks do, is minimize their tax burden. They pay, a lot less than that from these same strategies. So it's nothing to feel bad about being practical with your taxes. And I appreciate your very accessible insights about what makes you unique there. And you even have that guarantee. If you don't double the savings, double the cost of your package, your strategic tax planning package, and you get your money back. So very good stuff. Cory, did you have any initial thoughts before we ask Jake a couple follow-up questions?
No, not a whole lot. I agree with you, David, though I would say I don't like any taxes. So any way to avoid them is better, legally. And I know that Jake has lots of great strategies for that. We've talked many times over the year. And I believe I was the one who actually sponsored him into BNI. So
Yes, you were.
take credit for that. Yeah, so go ahead and move on.
Yeah. Yeah. And I said that a little bit tongue in cheek, I love that about these are the things the IRS doesn't want you to know. So anything they don't want me to know, I want to know. Um, but, we just wanted to ask you what you see coming down the pipe from the Biden administration, how that might interact with what's going on in California too. So, at a 50% income tax already and 37% capital gains tax, can we see those rates go even higher, or what are you thinking to kind of?
Well, so first of all, let me just go back and say that 24, what I talked about earlier was that included self-employment taxes for the self-employed, and also for the employed, they pay about a little bit less than that. They might be paying instead of 49%, it'd be about 7% less, so it'd be 42%. And that's just in the 24% bracket. And right now, the 24% bracket goes up to about 160,000. This is for 2019, actually. It goes up to 163,725, and if you're married, it goes to 321. And then after that, you get bumped into the 32% bracket. So your taxes are going to go up another, 8%. And at some point, the employment taxes are going to start dropping back down. So you still are going to end up in an over 40% bracket once you go over that level. The tax, Biden has, when he was running, he actually put forth what he planned to do in terms of taxes. We don't know how much of this is actually going to get done, but this is what he talked about. He talked about raising the top marginal rate, which right now is 37%. That was lowered by the Trump Tax Cuts Act in the end of 2017 and took effect in the beginning of 2018. He's going to raise that back to 39.6%. Now, that's not going to affect anybody who makes less than $400,000, but that is something that they've talked about doing. They're thinking about adding back the OASDI, which is basically the FICA and the FICA taxes on. Right now, you pay up to about $142,000. You pay your Social Security and your Medicare taxes. They're going to add that back for anybody making over $400,000 on any income over $400,000. They'll be paying that extra 12.4%, which is quite a bit. They think about reimposing what's called the PEAS limits so that it phases out some of your itemized deductions, capping your itemized deductions at 28%. Scaling back your qualified business income deductions. Right now, you get 20%. They're talking about lowering that. That also came with the Trump tax cuts a few years ago. And they're going to raise the corporate tax rate back up. It was cut from 35% to 21% by President Trump. They're thinking they're going to raise it back up to 28%, about halfway. And then there's a lot of things they're planning on doing for inheritance. They're talking about eliminating the step up in basis for inherited assets. That's something that's been talked about by Congress for many, many years. So I don't know if they're going to do that. They're talking about rolling back the estate tax exemption, which is currently $11.7 million per individual and twice that for a couple. Back to about 3.5 million per individual, back to where it was during the Bush years. And possibly eliminating the 1031 exchange. 1031 exchanges, when you sell one property and buy another, you're able to defer the taxes by doing that. It used to be up until 2017 tax law change by Trump. That used to apply to businesses, but it no longer does, and they're talking about eliminating that. So those are a lot of the things that they're talking about doing, and that was probably a much longer answer than I should have given you. But anybody who wants to know more about that is welcome to email me, and I can send out I'll put them on my emails list to keep them appraised of any changes that we see coming forth.
Thank you. Cory, do you have any questions you want to ask? Oh, you're muted.
Unmute, I know.
Okay.
Gotta bounce around here. I got this nifty thing for my monitor I've got to set up where I can put the questions on the side, but I have too big of a monitor, so I haven't figured it out yet. So what techniques, Jake, would you suggest for minimizing tax burden in retirement?
Well, in retirement, there's a lot of things that can be done. You really have to know how to do this, but I really like being able to move monies from regular traditional IRA accounts to other savings vehicles like a Roth type of account where the money goes in and you're growing it. I like insurance types of arrangements where you're growing money inside of insurance policy that also gives you insurance on the portfolio itself because it can't ever go down. It just goes up, and it also allows you the possibility of leveraging it like you would real estate. So that's some pretty good advantages there. And then once you're in those types of things, it's important to have a really good advisor who's going to take your, is really going to understand you and understand what kinds of risk you can take. The biggest mistake I see often outside of taxation is just people either taking too much or too little risk. And that really can hurt their performance. There's been a lot of studies done that people tend to get in and out of the markets at exactly the wrong time. So, you know, if you're one of those people, for instance, who back in March or April got freaked out by the crash in the market and took your money out and lost $100,000, you're not going to get that back if you don't stay the course. So having the right planner and having the right plan is super important so that you can stay the course. And so that's really important. And making sure that your taxes, that you're not spending too much on the expenses of your retirement and not having too much of your money exposed to taxation. A lot of people are unaware, but if you buy a mutual fund, you can end up paying taxes on money you didn't even make, because every year that mutual fund sells stocks. So if you buy into a mutual fund and they bought, let's say they bought Tesla at the beginning of the year and they think, okay, Tesla's turning around, there's been enough with the Tesla, let's sell off like 50% of our stake in Tesla. And they bought it a year ago and Tesla has gone up by a factor of 6. So there's going to be this huge capital gain. And guess what? You didn't participate in that, but you are going to participate in paying the taxes on that sale because the capital gains get distributed to the current owners of the mutual fund. So it's really important to understand things like that because they can have a huge impact on your retirement savings when, especially in non-qualified funds, to make sure that they're managed in such a way that they're not subject to a lot of taxation. And also the location of the monies, you know, making sure that your when you have different types of accounts, you really want to make sure that you're using them wisely. So you want to make sure that you're using the right type of account for things like stocks where you're going to get capital gains treatment and good treatment on your dividends versus fixed income where that's going to get taxed as ordinary income. And so it's important to have those types of those different types of investments located in the right types of plans.
Great. Just a last quick question. Who would be an ideal client for you?
Well, I work with a lot of people across the board, but usually, you know, if they have their own business or properties, and they've gotten past that first step of having a successful business or having a successful real estate portfolio, and they're making money, and they're upset about how much they're paying in taxes, there's often a lot of things we can do. Also, people who are looking at transitioning into retirement, if they come to us a year or two before they want to sell a business, we can often bump the amount that they can pay, that they can get paid for that business, and reduce the amount of capital gains they'll have to pay on that amount. So those people are ideal. And, you know, people who have, who really want to, people who are fed up with paying more in taxes than they feel that they should. If anybody has that type of feeling, they're often good candidates.
Great. Well, thanks, Jake. We are about at time here. I don't know. I did want to just ask if what the best way for somebody is who might be interested in getting that free consult or getting in touch with you, what they might want to do.
Let me see if I can find the slide that has my so this is my, oh, there's no phone number there.
Yeah, I can always put your number in the chat or in the comments, or if you do have that slide handy, you're welcome to share it.
Okay, so right now I've got this up here, and it's got my website,
Okay,
my
you got to
address.
hit share because
Oh,
we're not seeing it yet.
I got to hit share. Sorry about that.
No
Share
problem.
screen. Share. And
There we go. We got you.
slideshow view show. So here, this screen here has my phone number and email address down at the bottom. Anybody's welcome to contact me at either of those. And if you want to receive a newsletter from me, you can contact me at my email address and say newsletter. If you want some sort of, if you'd like a no obligation review of your tax return or a second opinion on anything, you're welcome to contact me. And if you want to explore tax planning to see if you qualify for it, you're welcome to contact me.
Excellent. Well, thanks a lot for the presentation. I know we just scratched the surface on some of these issues. We do look forward to having you back at some point to talk about some other key issues, or as we get further into the Biden administration, also seeing what folks in Sacramento do to provide some, strategic advice and insights about how to keep people, from paying more than they should.
Yeah. And I wouldn't expect any changes to come forth for this 2021 tax year. I think that any legislation that's going to happen is going to happen in probably the third or fourth quarter for this year and not take effect until